Okay, so look, the whole thing with this, just to really zoom out, is you want to accelerate your debt line down as steep as possible, which then frees up money so that you can then have your asset line as steep as possible. So you're decreasing debt, freeing up cash, and then increasing your asset line. So that's the whole point of it. And you can do that by saving money and saving time. So those are the two things that you're looking to save. What you're not told is that when you have a mortgage, in fact, Chris, let me ask you, I don't know whether you've got a mortgage or not, but if you don't have one, you can talk for people that you know that do have one. You have mortgage payments. What's the frequency of those mortgage payments? When do you pay your mortgage off?
Well, they're usually monthly, aren't they, for 25 years?
Monthly, exactly. Is it an option monthly, or is that just what they tell you? Or do you even have an option?
You just assume that's what people pay, in it, monthly. And you,
absolutely,
you don't know any different.
Absolutely, yeah. And, you could say, well, if you get paid monthly, then it kind of works out, monthly bills. So here's what you're not taught is mortgage debt. The interest is calculated daily. Okay, and that's really, really important. So what happens is, let's say you've got £100,000, yeah, on a mortgage. It'd be quite a small mortgage, but let's say you do £100,000. At the end of day one, the interest is calculated on 100,000. Okay. On day two, at the end of day two, the interest is then calculated on not 100,000, but 100,000 plus interest from day one. Day three, interest is calculated on not 100,000, but 100,000 plus interest from day two and interest from day one. So when you pay at the end of the month, there's been this snowball effect where the interest has kept accumulating, and it's interest on interest. Does that make sense, first of all?
Oh, it makes perfect sense. I mean, but yeah, I mean, I guess the point you're getting at is a month's worth of interest accruing over 30 or 31 days on, say, $100,000 mortgage, or maybe a $500,000 mortgage, which is not abnormal these days, is it? For your that's for your first house, right? It's like, if you wait that whole month, they're hitting you with interest every day on that. Whereas if you nail a little bit each day, it might not seem a lot, but over the course of that 25 year, you're not going to get to 25 years because you're going to pay it. The sort of compounded effect of this is you're going to shorten your mortgage. The fascinating thing is how much you can shorten it by, which am I right in saying you can sort of shorten it down to a third?
It depends. I think, first of all, you've absolutely nailed it. So just to double back for people that maybe we lost people along the way. So the mortgage, the interest compounds, and it's only a small amount, but it's a small amount on a big number. So even a small percentage on a big number over 25 years, like you said, becomes a big amount. The aim is to stop that, or to limit that snowball effect as much as you can. So, for example, let's say just for the ease of numbers, let's say your mortgage is £800 a month. Okay, and let's say it's a typical 4-week month, just to keep things very simple. Rather than paying £800 at the end of the month once, if you paid £200 every week, you're paying the same, as in the same amounts leaving your pocket, but you are limiting that snowball effect. You're stopping it kind of getting too big. And what this does is it brings, again, the whole point is accelerating your debt line down as quick as possible. And you're just paying it off quicker. Now, if you do it weekly or fortnightly, every 2 weeks, there's going to be extra payments within the year. For example, there's 12 months in the year, but there's 26 fortnights. So there's kind of two extra, if you're doing it every 2 weeks, two extra payments that you would make over the year. And again, that only adds to the acceleration out of this debt. So you're totally right. You're accelerating out of it and it compounds, and you stop that compound effect. Now, the amount that it can save in money and time depends on a few different metrics: the balance of what you've got left, the interest rate. You know, we always used to say, look, the higher the interest rate, the higher the amount, the more we can actually help. Because, you know, if you're only paying, let's take it to the extreme, 1% on your mortgage, then there's not a lot of interest there to be saved. Whereas if you're paying 6%, which will be a lot of people now as interest rates have gone up, 5-6%, then there's more to save. There's more that you would have been paying that you now can accelerate out of. The other interesting thing is that when you pay less interest, or you save the interest, James always says money saved is money made. Okay, so that's money in your pocket, not in their pocket. What that does is it means that you shorten the time. So when you look at the whole picture of accelerating out of your debts, freeing up cash, and then building your assets, is let's say you can pay your mortgage off 5 years earlier, and it was £800 a month, just to take that as an example. You've now not only saved probably tens of thousands of pounds in interest over that period, but you've now got 5 years at £800 a month of money that you would have been paying that you now don't have to pay. Now, what most people like to do in this kind of microwave society where everything's now, we don't want to wait for anything, is they take that £800 a month and say, let's go on holiday, let's buy some more things, nice things that you know, shiny things that you see on the internet and whatever. If you can be disciplined to take that £800 a month for 5 years, which will be a lot of money, and then put that into assets, you now start to accelerate your asset line. By the way, this, let's say, 25-year period that you paid your mortgage off in 20 years rather than 25, and you freed up this cash, that's not cost you more. You've just been smart with the order that you pay things. And if you took someone that just pays their mortgage monthly for 25 years, at the end of that 25 years, they've just paid off their mortgage, no assets, no free cash, nothing like that. And you take someone that does the acceleration, they've paid it off in 20 years, got 5 years worth of cash, put it into assets. Those assets can now grow. If you put those two people side by side, they're in a vastly, vastly different position after the same 25-year period. And this is what it's all about. You don't get taught this stuff. But small changes make a big difference. And what you don't know in the financial world, unfortunately, this is a bit of tough love, does hurt you. It does, and we've seen it. And again, we can lay all this out. We can show you some numbers and show you exactly how much you'll save and how it all works. But that's the top and bottom of it. You know, you're told by banks, you know, this is a safe place for your money. We'll look after it. You know, look, we've got these big buildings and we do all these complicated things that you won't understand. Give it to us. Give your money to Wall Street and to investors, they'll look after it far better than you will.
A lot of people that may previously have been on the sidelines of the freedom game, can we say?
And we've got to understand our enemy, haven't we, to beat them. If you don't understand the way it all works, this system, then you'll never beat it.